Hey guys, Drew here, and welcome to the Engineering Success YouTube channel, where every week I talk about different personal finance topics. If you're interested in that type of content, please make sure to subscribe. That way you don't miss out on any of my new videos. In today's video, I'm going to be talking about how to use a PE ratio to value a stock. I know this is something that a lot of new investors are generally confused by because they hear people talking about PE ratios and EPS and all these different acronyms that they've never heard before. And I just want to try and demystify that so that you can become a more informed investor and not feel so overwhelmed when you're trying to get started planning for your future. So at the simplest terms, a PE ratio is a way to measure how expensive a stock is relative to the amount of money that that company made in the previous year. To calculate a PE ratio, you take the current share price, meaning the price per share of stock that you would pay now for that company, and then you divide that by that company's earnings per share from the previous year. So what you're trying to look at is how much does this stock cost divided by how much money did this company make last year. That way we can see how much we're paying versus how profitable that company is per share of stock. Generally speaking, we can expect that the more profitable a company is, or the higher its earnings are, the higher its share price should be. And this is the way that a stock is supposed to function. However, depending on investors' attitudes on perceived future growth or on perceived future loss of revenue, investors will invest more heavily into a stock or less heavily into a stock, which will then lower or raise its stock price without changing the earnings of that company. This creates a situation where not all stocks are going to be valued fairly relative to their earnings. Some will be overvalued compared to their earnings and some will be undervalued compared to their earnings. Generally speaking, fair value is determined by the S&P 500's PE ratio. So right now that is about a 15, and that's what it generally stays near. So when you're looking for stocks and you're looking at comparing PE ratios, what you're wanting to look for is a PE ratio that is lower than 15 if you're wanting a stock that is undervalued compared to its earnings. And if you see a stock that has a PE ratio that's higher than 15, then that means that that stock is generally expected to grow more than its earnings that it has already had. This means that it might be overvalued for its earnings today, but it could still end up growing more in the future, so that's why you would pay a premium for it. Keep in mind that there is a limit to how low a PE should be, because as an example, if a PE ratio is negative, well, we know that the stock price can't be negative. That means that you're dividing the stock price by earnings that are negative. So if a PE ratio shows up as negative, then that means that the company lost money in the previous year. This is definitely a red flag that you want to, make sure that you understand enough about the company and that that company is going to be able to survive before investing in it. Sometimes it's okay to invest in these, but if you're judging strictly off of PE ratio, then you might want to reconsider that stock. So now you're probably thinking, well, then what is the reason that anyone would invest in a company with a high PE ratio? And that's a fair question, because why would I want to overpay for something? Well, the key thing to keep in mind here is that PE ratios are back-looking. What this means is that since we are looking at the stock price today and comparing it to earnings from last year, we're not really keeping in mind what the earnings are going to be this year because we don't know those. We can forecast that, and there is such a thing as a forward PE. However, that's just an estimate. Generally speaking, I just look at the current PE ratio because we don't know. As an example, like right now, the forward PE ratios that were being projected in January are nothing close to what they are right now because catastrophic events occur, and that can vastly change what the expected earnings per share are for the year. That's why I like to look back, make sure that the company is undervalued relative to what it has already proven it's capable of. But that's a personal preference. That being said, the reason a person would buy a company that has a higher PE ratio is that companies that are perceived to have more growth in their future than the earnings they had last year, those companies trade, generally speaking, at a premium because investors expect that their future earnings are going to catch up to that valuation and share price. A good example of this is Amazon and Apple. So I don't think anyone's going to argue that Amazon or Apple are bad companies and that you shouldn't invest in them. But there is a big difference between them when it comes to PE ratios. So when you look at Apple's PE ratio, it currently sits at around 21, which is a little bit of a premium, but That's understandable. It's a pretty good company. It's definitely one that a lot of people are, going to invest in, even there if they're new investors and they're not even looking at PE ratio. Apple is one of the most popular stocks for people to buy. It makes sense that it would be at a slight premium. That being said, then you look at Amazon's, and Amazon's is in the high 80s. When I looked at it today, it was at 88.8. That is astronomically high in my personal opinion. So personally, I would prefer Apple over Amazon from a P standpoint. That being said, this doesn't mean that Amazon is a bad investment. I mean, obviously, it's a huge company. It's going to keep growing. Probably a good call to invest in it regardless of PE ratios. What it does mean is that it is more expensive right now based on the earnings that it's proved that it's able to produce. With all that said, which stocks you decide to invest in is ultimately up to you, and PE ratios are just one piece of the puzzle when it comes to making investment decisions. Personally, I choose to not invest as much in companies with high PE ratios and usually stick for companies with low PE ratios, but that I see have unrealized growth potential. And that's just my personal preference. And the reason is I want to find something that has proven that it is going to be profitable and at the same time is at a deal, because I want undervalued assets that will still grow. And then that way I get a little bit higher of a return with hopefully even less risk because it's already at a good value. And if you're interested in getting started investing, be sure to check in the description box below where I have a link for both Webull and for Robinhood. Both of these are great investment apps and brokers that you can trade stocks directly from your phone for free with no commissions. Great place to get started. If you click the Webull link below, then you'll get 2 free stocks when you sign up and when you deposit $100 or more. And let me know in the comments which 2 free stocks you got. If you pick Robinhood, you'll also get 1 free stock with them, and both are great apps. You'll just have to look at the 2 and decide which one makes the most sense for you. But as a general rule, Robinhood is a little bit better for beginners. Webull is the one that I personally prefer because it has a lot more good analysis tools and they have a lot more options, like being able to set up a Roth or a traditional IRA that Robinhood does not have. That being said, I think both are great for people just getting started, so be sure to check those links down below. And if you're interested in stocks that I'm investing in, be sure to subscribe to the channel and come back for more weekly personal finance videos, because right now I'm going to be talking a lot about the stock market and investing, because that's what's affecting a lot of us right now. There's a lot going on since the beginning of March, and it's an exciting time to be getting started investing while things are at relatively low prices. So be sure to check that out. Did a video last week on which travel stocks I think are good buys, and I'll be doing videos in the coming weeks about other stocks that I see that are good buys in different areas. So be sure to keep coming back. Thank you guys for watching. Really appreciate you. Don't forget to like the video if you found this helpful. And if you have any questions in the comments or different topics you want me to cover, be sure to put those down below. I'd love to hear back from you, and I will see you guys next time.